There's a moment in every major financial shift where the outcome was already decided and almost nobody noticed. Not because the information wasn't available, not because it required a genius to decode it, but because most people were staring at the wrong thing entirely. Right now, that moment is happening inside the XRP market. And the evidence isn't hiding. It's sitting right there on the blockchain, written in numbers that don't lie, don't panic, and don't get emotional. My name is your name, and today I'm going to show you the architecture of something most people are completely missing because they've been too focused on a single number that ironically is the least important signal in this entire story. Let's go back to a concept that anyone who's ever studied markets eventually learns the hard way. In 1965, a young Warren Buffett wrote a letter to his partners that said something that has echoed through decades of investing wisdom. He described a business that was deeply undervalued, one where the fundamentals were rock solid but where the public was in full panic mode because the stock had drifted sideways for over a year. His conclusion? That sideways drift wasn't a warning sign, it was a gift. Now, I'm not here to draw a one-to-one comparison between Buffett's era and crypto. These are different animals entirely. But the psychological pattern he identified where short-term frustration masks long-term structural opportunity, that pattern is timeless. And right now it is playing out in XRP with a precision that is almost textbook. There are two clocks running simultaneously in this market right now, and most people are only watching one of them. The first clock is the price clock. It's the one on every chart, every app, every notification that buzzes your phone. It went up, it went down, it's sideways, it's frustrating. You know this clock intimately. The second clock is the structural clock. It doesn't make noise, it doesn't send alerts, but it is moving steadily, consistently, and with enormous implication. For what happens when these two clocks eventually sync up? Think of it like this. Imagine a dam. The water behind it has been rising for months slowly, quietly, without any dramatic headlines. But all people keep watching is the downstream side, wondering why nothing is flowing yet. The structural clock in XRP's market right now is measuring something specific, where the tokens are. Not what they're worth today, where they physically live in the ecosystem and who controls them. And what that clock is telling us is one of the most significant supply-side stories this asset has ever produced. Here's a fact that changes your entire lens if you let it sink in properly. When a token sits on a centralized exchange, it is in market terms loaded and ready. It can be sold in seconds. It shows up in the order book as available supply. It is, structurally speaking, ammunition for price suppression. Now consider what happens when that same token moves off an exchange into cold storage or institutional custody. It disappears from the sell-side equation. It can't be reactive. It requires deliberate, effortful action to bring back to market. It is, for all practical purposes, removed. Here's what's happened since the most volatile crash event of XRP's 2025 to 2026 cycle, the event that shook retail to its core and triggered billions in liquidations across the broader crypto space within a single day. In February 2026 alone, over 7 billion. XRP left centralized exchanges a single month. Gone from the order books, moved into private and institutional custody. And that's not a one-time event. Exchange outflows have been accelerating. The net exchange-held supply of XRP has dropped 16% since that crash. That means roughly 1 in every 6 tokens that used to be sitting available to sell is no longer there. Now here's the question I want you to sit with. Who is pulling those tokens off exchanges? Because someone is making an active, deliberate decision, not once but consistently, day after day, to remove this asset from the liquid market. And that is not the behavior of someone who thinks this is going to zero. That is the behavior of someone positioning for something they believe will matter a lot when the timing is right. Let me paint you a picture of two different types of buyers, because this is where the psychology of markets gets genuinely fascinating. The first type reacts. They see XRP at $3.6 and they feel the excitement. They buy. The price drops to $2. They feel the anxiety, they hold, but nervously. It drops again. They feel the dread, they reduce, or they exit. Their decisions are driven by what the price tells them to feel in the moment. This isn't stupidity, it's neuroscience. The human brain is wired to treat financial loss and physical threat through similar pathways. A portfolio that loses 40% of its value activates the same stress responses as a genuine danger signal. Fighting that response requires something most people don't think to build, a framework that is bigger and more deeply understood than the day-to-day emotional noise. The second type of buyer operates from a different foundation. Entirely. They built their position thesis before the volatility, and they tested it rigorously against bear cases, counterarguments, and worst-case scenarios. So when the price dropped and the fear crept in, their framework held, not because they're emotionally bulletproof, nobody is, but because they had already answered the question. That fear always asks, which is something fundamentally wrong? They looked at the on-chain data. They saw the tokens leaving exchanges. They watched the largest wallets in the market quietly, systematically add to their positions not once, not twice, but every single day. The 30-day accumulation rate from the largest wallet tier has been running at over 11 million XRP per day. Every single day. Through geopolitical tension, through flat price action, through negative headlines, through ETF outflow reports, 11 million tokens, accumulated daily by the people with the most capital and arguably the most information in this market. When I see that number, I don't think about the price, I think about the conviction required to sustain that pace. That is not a trade, that is a structural position being built for a reason. Now let's talk about the catalyst side of this equation, because supply contraction alone doesn't produce an explosive move. You also need a demand trigger. Here's what makes XRP's situation different from most digital assets. Most tokens are still waiting for legal clarity. They exist in a gray zone where institutional compliance departments can't sign off on large-scale allocations because the regulatory classification is still unresolved. That uncertainty isn't just a technicality, it is the wall between current price and the institutional capital that's been watching from the sidelines. XRP has already cleared one of the biggest legal hurdles in crypto history through the SEC resolution. That's not theoretical, that already happened. Now, pending legislation, specifically the Digital Asset Market Clarity Act, has the potential to codify the commodity classification of assets like XRP into permanent federal law. Think about what that means practically. It hands compliance departments the memo they've been waiting for. It answers the question that has kept pension funds, endowments, and registered investment advisors on the sidelines. The custody infrastructure is already in place. The ETF frameworks already exist. The institutional rails are built. The only thing that has been missing is the green light from a legal standpoint. And here's the structural irony of this entire setup. The people who have been accumulating over these past months, pulling supply off exchanges, buying 11 million tokens a day, they are positioning before that green light arrives. They are buying. The silence before the announcement. When that institutional wave moves, it will be looking for supply, and based on where the supply currently sits, the available tokens will be far scarcer than at any point since 2021. Basic supply and demand, thin order books, motivated new buyers. The math isn't complicated, it's just invisible to anyone who stopped looking past the price chart. Let me be direct with you for a moment, because I think this is the part that most people need to hear most. If you've been holding XRP through this drawdown and feeling that creeping doubt, the maybe I'm wrong, maybe this is taking forever, maybe I should just cut my losses feeling, I want you to understand something. That feeling is not a signal from the market. That feeling is a signal from your nervous system responding to uncertainty. And your nervous system, as brilliant as it is, was not designed to evaluate blockchain supply dynamics or regulatory timelines. The signal that matters is not how you feel. The signal that matters is what the data shows, and what the data shows is a market structure that is tightening, not loosening with every passing week. Now, I'm not telling you this is a guarantee. Nothing in markets is. Anyone who tells you otherwise is selling something. What I am telling you is that the people with the deepest pockets and arguably the deepest research are not behaving like people who think this is over. They're behaving like people who think this is early. And there's a meaningful difference between those two things. The question each person has to answer for themselves isn't, will this go up? That question can never be answered with certainty. The real question is, do I understand what I own deeply enough to stay positioned through the period between now and when the thesis plays out? Because understanding is the only thing that converts volatility from a threat into a tool. Here's what I want you to take from everything we talked about today. The price is a lagging indicator. It always has been. By the time a price move becomes obvious to everyone, the structural setup that caused it was built months earlier, quietly, unglamorously, during exactly the moments when most people were too discouraged to pay attention. The XRP supply story, the accumulation pace, the exchange outflows, the regulatory runway, none of it is a price prediction. I don't know the date. I don't know the exact number. Anyone who does is lying to you. What I do know is that the architecture being built right now by the wallets that have consistently made the right structural calls looks nothing like an asset being abandoned. It looks like an asset being loaded, and I'd rather understand why the structure looks the way it does and make a calm, informed decision than react to a price chart and wonder later what I missed. So here's my question for you in the comments. What's your framework? Not your price target, your framework. How do you evaluate whether your thesis is still intact when the price is doing nothing interesting? I genuinely want to know, because I think that conversation is more valuable than any price prediction we could have. As always, stay curious, stay grounded, and don't let a number on a screen do your thinking for you. See you in the next one.